Welcome back to another episode of Investies. I'm your host, Linda Garcia. This week on the podcast, we are going to review some fresh inflation data that just came in and also discuss some updates in the market. We do have a very volatile September that is currently taking place in the market. It's important for us to know, however, that September has historically been the worst month for the SMP500 over the last 10 years. September has averaged a loss more than 1%. So while we are expecting to have a not so great September just based on historical data, we do have that additional layer that it is an election year. The market is currently taking a pretty steep tumble down, and this is in part because of fresh CPI data that came through. We will talk about that later in this episode. And then, of course, we also had the presidential debate last night. This is being recorded earlier in the week. And while I can't exactly gauge what the market is reacting more to, what we can take a look at is how Trump media is performing after this debate. Back in the spring, we did an episode on Trump media. The ticker symbol is DJT. We will be sure to link that episode in the show notes so you can get a clearer picture of this publicly traded company. It does have Truth Social rolled in under it. It is down 21% since this morning in early trading hours, and it is down overall 76% from its all-time high from when we recorded the episode, giving the detailed information on this publicly traded company. Given the steep drop in the publicly traded company since early trading hours on Wednesday morning, it is evident that investors in Trump media are not happy with the performance of the presidential debate. It is also an indicator that his base, who also invests in the publicly traded company, could be feeling negative about the potential presidency. Analysts on Trump media have acknowledged that the stock performance of this publicly traded company will most likely be in correlation with how Trump performs and executes this campaign. So there is a level of risk there, and we could potentially see a lot of volatility. Although the stock has not recovered to its all-time high, as I mentioned earlier, it does have a 76% drop since its all-time high. And as the morning goes on, the stock continues to drop. So while we can't really tell if the market is reacting to the presidential debate, we do have this isolated indicator with Trump media. Given that the month of September is historically the worst month for the SMP500 over the last 10 years, I do want to talk about where we are right now and how it is performing from its all-time high. So the Dow is down 3.6%. The S&P 500 is down 4%, and the NASDAQ didn't quite recover from the one drop that we had at the beginning of August. We are looking at negative 9.6% for the NASDAQ. So the NASDAQ right now is really close to entering correction. Just as a refresher, when the market is correcting, that means that it has dropped by 10%. When the market is crashing, that means that it has dropped by more than 20%. When we zoom out a bit and we look at the stock market year to date, we are still performing incredibly well. The Dow is up year to date 6.26%. The S&P 500 is up 14.22%, and the NASDAQ is up 14.09%. 0.02%. So we are still performing exceptionally well for the year. As a reminder, on average, the S&P 500 increases anywhere from 8 to 10%. And so we are, 3/4 into the year, and we are still doing exceptionally well for the year. And since we're zooming out, let's just go ahead and zoom out since the crash of 2020. So since the crash, the Dow is up 109%. The S&P 500 is up 134%, and the NASDAQ is up 144%. I want us to acknowledge that because I feel like zooming out and looking at the stock charts can be very beneficial when trying to regulate our emotions and seeing such a volatile market in a short amount of time, like we have seen in the month of August and in the month of September. This puts everything into perspective and is a strong reminder that intelligent investors invest for the long haul and do not necessarily get emotionally caught up on these short-term swings. In fact, we lean into these swings and take advantage of the market. We received fresh CPI data. We're going to go through the CPI data and break that down. CPI data is very important this month because Fed Chair Powell and the team of the Federal Reserve, who writes monetary policy, is trying to figure out whether or not they should lower interest rates. As a reminder, CPI stands for Consumer Price Index, and it measures the change in prices paid for goods and services over a period of time. Therefore, it is measuring inflation. The Federal Reserve is looking for 2% inflation year over year. That is our goal. So for the month of August, we did see inflation increase 0.2%. This was in line with estimates expected from analysts. So analysts were expecting a 0.2% increase. This is positive because it means that we received exactly what we expected. However, it is also slightly negative because it also means that inflation is still increasing. The month prior, for the month of July, we had CPI data come in at 0.2%. So we experienced 0.2% in the month of July and 0.2% in the month of August. We have to get really clear and understand the numbers that are coming in. This doesn't mean that CPI hasn't increased and it's maintained its level from July to August, despite it being 0.2% in July and 0.2% in August. What this means is that it has gone up 0.2% in August from the 0.2% increase that we had in the month of July, which means that inflation continues to rise. Now, when we look at inflation on a year-to-year basis, we do have some positive news. So when we look at it year over year, CPI came in at 2.5%. We are measuring the last 12 months, and inflation is 2.5%. This is down from the year-over-year level in the prior month of July. That was 2.6%. So year over year, we did see a tick down from the July level. In addition to this, analysts were also expecting 2.6 year-over-year CPI number. And so again, it is positive that we beat estimates, meaning we were lower than what analysts were expecting at 2.5%. All in all, this is a mixed bag, meaning that we have some positive news and we also have some negative news. The positive being that we have seen year-over-year inflation come slightly lower, and the negative news being that we are still increasing month over month. In terms of how the market is reacting, we talked about this in the beginning of the episode. It is definitely having a negative reaction to the data. It is dismissing the positive side of the data, and here's why. Over the last several weeks, the market started to get really positive. We saw the recovery from August, and that was in part because the market started to feel like there was a potential for 50 basis points to come down on interest rates, meaning that they were expecting 0.5% drop in interest rates. And by them, I mean Wall Street. I mentioned in a couple of episodes back that Wall Street is 100% certain that interest rates are going to come down in September. I have been the contrarian on this perspective. Mainly, I just believe that it shouldn't come down. You all know that we're beating a dead horse at this point. But Wall Street is certain, it is positive. And as I look at this data, I remain in the stance. I'm doubling down here. I do not think that Fed Chair Powell should decrease interest rates, given that we are still seeing a 0.2% increase on inflation month over month. Inflation has proven to be extremely sticky. And I think for the greater good, we need to just hold still and not consider interest rates decreasing until 2025. In the CPI report breakdown, it is calling out that inflation remains a problem when it comes to housing and housing-related costs. The shelter component of CPI did go up 0.5%. If we look at shelter isolated, we are looking at an increase of 5.2% year over year. Now, if we decrease interest rates, what do we think is going to happen to housing? We have not seen the housing market break down. We have not seen the prices of housing really deteriorate. And so if we decrease the rates on mortgages, on borrowing money, what do we think is going to happen to the real estate sector? Maybe I am missing something. Nobody's talking about this. It's really frustrating for me because I am seeing things in a more pessimistic way, but only because I feel like I'm looking at the picture. And maybe there is something here that I don't fully understand, and I will understand when we come out on the other side of this. I remain contrarian. I do not think we should increase interest rates. As it stands right now, the stock market is down because it is upset that it anticipates that we will not have a decrease of 0.5 basis points or 0.5%, that instead we will only have a decrease of 0.25%. So it is pricing in how upset it is. That's why it is down this morning, in part. Again, we are going through elections. We did have a debate this week. And so there are definitely other factors in place right now. But the biggest catalyst of this morning's drop is the anticipation that we will only have 0.25 basis points decrease on interest rates. We will find out next week if Fed Chair Powell is going to decrease interest rates and by how much. I have been anticipating next week ever since the start of the year, so I'm definitely looking forward to see what the final decision is going to be on interest rates. If he keeps interest rates at the same rate, we can most definitely expect for the market to come down even further. The market will absolutely be upset because it is so certain that he will end up decreasing interest rates. So we will see what takes place. If he does decrease interest rates, I think we can slightly see a lift, although not too much of a lift because all of this news has already been priced in. The market is forward-looking and it will price in what it anticipates. Just like right now, it is pricing in what it anticipates to happen next week. Lastly, before we head out, I just want to share a little bit of the breakdown on how much inflation we've seen on individual items year over year. I feel like this is a really great reminder that while we do take a year over year average, there are specific things that we are paying for that have increased drastically. So again, these are year over year percentages. So for eggs, we are looking at a 28% increase. Juices and drinks, we're looking at an 18.3% increase. Frankfurters, we're looking at 11% increase. Dried beans, peas, and lentils, 6.8% increase. Beef roast, 6.7% increase. Butter, 6.7% increase. Butter is definitely coming down in how much it's increased year over year, but that one was going crazy for a minute there. And then we see ground beef at 4.9%, peanut butter at 4.7%. So you can see that year over year, some of these items have increased drastically. Now, when we don't look at food and we look at other costs, it's no surprise here that motor vehicle insurance has gone up 16.5%. We are currently hunting for a lower priced car insurance. I just can't do it anymore. I am over it. And then we have photograph equipment and supplies, 14.7%. Video discs and other media, 14.3%. Gardening and lawn care services, 13.5%. Cigarettes, 9.3%. Banking services like checking accounts, 8.9% more expensive. Those are some of the breakdowns there. There is an entire list of breakdowns. If you're interested in that list, I will link it in the show notes. All right, thank you all so much for listening to this week's episode. I'm looking forward to seeing what happens next week, and we, of course, will keep you updated. I'm your host, Linda Garcia, and you're listening to Investies, a Cosmic Standard and In Luz We Trust production. Special thank you to the team, Asia Simpson, Eliza Smith, and Jacob Winnick.